I'm writing a lot less checks today, but bigger checks than I used to, because the ones that I want to get involved in, I have to have the highest level of conviction that I want to have more capital in it.
This podcast is sponsored by Pragmatic Solutions, the player account management platform chosen by today's smart betting and gaming operators. Don't let technical constraints delay you from achieving your business goals. Expand your business, boost your margins, and dominate the market in any leading regulated jurisdiction with our powerful, flexible, and secure iGaming platform. Enjoy its extensive marketing tools, compliance protection, real-time data, and a wide portfolio of over 1,000 industry providers. It's time to upgrade your technology. Let Pragmatic Solutions show you the modern approach. Visit pragmatic.solutions and join the smart thinkers.
This podcast is brought to you by Pragmatic Play, a leading game developer providing player favorites to the most successful brands across the industry. With an award-winning multi-product portfolio of slots, live casino, bingo, virtual sports, and more, Pragmatic Play is powering up new possibilities of play through one single API. Visit pragmaticplay.com and discover your favorite every time.
Bingo, bango, bongo, the Vested Interest podcast is back here in 2025. Lloyd, you just came back from Barcelona. How did you manage to do over at the conference?
I could not believe how much a large city like Barcelona was just completely dominated by whatever, 65,000 registrants or 50,000 attendees. Absolutely massive show, and they really took over that city. I hope they're happy with the move.
Yeah, absolutely. And Benny, you mentioned just before the call here, you missed the first time ice this time. How does that feel?
Yeah, I don't recall ever missing an ice before. It's the first one that I've missed in who knows how long, but definitely had some FOMO, but looking forward to, we're just around the corner to next to New York. So saving all of my passion and energy for New York City, baby.
That's what I like to hear, my friend. That's what I like to hear. All right, guys, so we are back here with a full action-packed agenda here today. And by the way, I managed to, I think, attract every single bacteria that possibly is known to man from that conference. So you'll hear my voice a bit hoarse today, but we'll manage to do this anyway. But first and foremost, I want to kind of dive in a little bit on a topic we discussed before in the podcast, which is on the topic of prediction markets. So this election cycle, of course, introduced the rise of political prediction markets in the US, which became popular as an alternative political temperature check, if you will, to what some people viewed as the flawed polling that they saw in 2016 and 2020. Polymarkets, an offshore company, gave birth to this trend, followed by Kalshi, a US domiciled company, unique because they did not enter the market as a sportsbook, but rather by offering customers to purchase futures contracts to place money on the outcomes of the elections. As such, they fall under the regulation of the federal CFTC that oversees such contracts and not by the local state gambling regulators. More recently, though, Crypto.com and Robinhood have followed suit by offering CFTC-regulated futures contracts on the outcome of sporting events like the Super Bowl, making the product instantly available in all 50 states in the US. There are, however, voices that say that the product is indistinguishable from traditional sports betting and should be regulated as such. So, Lloyd, can you expand on what is currently happening with the kind of prediction markets and the derivative contracts that is being used as a veil, if I dare say, to offer sports betting? And what can we expect moving forward, particularly now as Trump 2.0 has taken office?
I think there's a few things happening at the same time. The idea of risking money on certain outcomes, whether for economic hedging purposes or otherwise, and doing so online and on the internet is getting as popular and mainstream as ever in the US, in part because of the legalization of sports betting, in part because of the prominence of platforms like Kalshi and Polymarket, as you described. Also, in part fueled by speculative crypto meme coin mania and whatnot. There is just an extra appetite for exactly that, for all sorts of speculation. And there is a change in administration, change in CFTC chair, and it appears that it is very specifically in the direction of being more permissive toward or less antagonistic toward various activities that might have previously sat perhaps on the line between gambling and investing or something like that. There's no doubt that under the hood, sports betting is a market like any other. It functions sort of like, I don't know, like a binary futures market where DraftKings or FanDuel are just always the counterparty. So, regulations aside, I think one of the reasons we always find ourselves in some version of this conversation is because inherently sports betting is a market, or it can be thought of as an asset class in the way that most other securities are. I think it's hard to have the crystal ball out, but what I can say with certainty, just based on all the pitch decks that we get and the conversations we're having, is that this trend is not going unnoticed, and that all sorts of interesting groups are coming up with unique ways to use insurance policies and custom swap contracts and interesting derivative mechanisms, whether crypto or non-crypto, centralized or decentralized, to initially offer some sort of at least presumably genuine economic hedging instrument, but that at some point perhaps could be offered as a de facto sports betting substitute. Granted, I don't know if I've seen anyone quite going as far as to replicate or offer something that would be a substitute for a micro bet or a same game parlay or even any form of in-game bet, but certainly as relates to season-long player and team performance and major futures style outcomes such as championship or MVP and whatnot, it does look like we're at, I don't know if watershed moment is an overstatement, but some sort of inflection point in terms of at least the amount of entrepreneurial horsepower that is being put behind new types of conceptions and modalities in this space. I think only time will tell which one of those, succeed and which don't, and which gain the most traction. But I think it's quite interesting and certainly is quite disruptive potentially to the incumbent model that not too long ago probably never really thought Robinhood, whether through a CFTC regulation or otherwise, would be a substantive competitor or substitute product.
Yeah, I think building upon that, I would absolutely say we're at somewhat of a watershed moment within this whole thing. And, the idea that on a national basis, and granted, there are some significant differences, as you allude to, Lloyd, between the product that a FanDuel, DraftKings, a Caesars, and an MGM offer versus a product that we're seeing today from a Kalshi and a Robinhood and whomever else. So it's not just like they're much less than a watered down version of sports betting. And we got to get the terminology right, because they wouldn't want it to be called sports betting. It isn't. It's the buying and selling of contracts. And there's no way that within the existing structure that we've seen in these early, I don't even want to say early days. We're before the early days. In a year or two from now, we're at the early days. Now we're in the pre-innings before the baseball game starts, so to speak. But what can those national products actually become? And I know that you, like I, are seeing all sorts of pitch decks with all sorts of creative approaches. And at the end of the day, I think what everyone needs to remember is that scale is going to win, right? And the reason why some of these, a Robinhood and a crypto.com becomes compelling is because they bring scale to the table. And, look, I've said before, and I'll say again that, sports betting was the initial, when it launched in the US state by state, was the initial kind of foray into what becomes a funnel over time of real money gaming opportunities and the growth of real money gaming as a meaningful form of engagement for the US populace and North American populace and beyond. And, we're now seeing that. It's sports betting has its limitations. When we see individual states come up and we're seeing now wanting to increase the taxation, that really plays into the hand of all the other verticals within real money gaming to allow them some opportunities, whether it's prediction markets or sweeps. And I know we're not talking about sweeps and fantasy on this particular segment, but all of it is a vacuum that lends itself towards real money gaming and the appetite of sports engagement and the appetite of having some sort of financial interest in the outcome of a sporting event. But the power of some of these companies, and as you allude to with the administration, I wouldn't entirely dismiss Donald Trump Jr.'s involvement in Kalshi. I don't think that's irrelevant. And Kalshi obviously announcing that they're getting into the sports markets, obviously very predictable. There's no surprise there at all.
Yeah. I mean, as you point out, Kalshi have loaded their board of directors with Donald Trump Jr. They have Sequoia on the cap table as well. And I feel this is really a summary of the US market that is repeating itself several times, where, daily fantasy sports was a way to offer sports betting, taking advantage of the loophole in UEGA back in the 2000s, giving birth to that product that was also legally questionable. And by time it got straightened out. Then, of course, DFS 2.0, sweepstakes, and now we are seeing this happening again with the prediction markets and the futures contracts. So on that note, where do we stand legally today? So Kalshi is regulated by the CFTC. The CFTC ordered Kalshi they ordered Crypto.com to cease operations with their futures sport contract, but Crypto.com refused, because they wanted the incoming chair of CFTC from the Trump administration to give their word on what they thought this was all heading, right? So where do we stand right now? Do we have any more information? Where is this heading, Lloyd?
Well, what we've seen that Crypto.com indicated is that folks who already have a CFTC license of some sort seem to be somewhat emboldened by the new administration, shifting of the Overton window, whatever it is. And rather than doing the conventional process that especially a new applicant would have to go through, where you apply to offer a certain type of futures contract, what Crypto.com did was they just provided notice, and they said, we're doing it starting now. And then the CFTC came back and said, stop doing it. And they said, no. And that's a much different approach than certainly what is traditional in regulated sports betting, where you apply for a license and you go through the process, and usually there's a great deal of revisions and scrutiny, and then only afterwards do you go live. And so I think we're going to continue to see that. Also, the CFTC has a reputation for saying no to things, but leaving clues in their no's as to what would have to happen in the future for their no to become a yes. And I am not expert enough to evaluate these things, but people who I talk to who deal with the CFTC all the time tell me that their reading of the CFTC's commentary over various sports-related predictions and election prediction markets indicates that it's not a no forever. It's just a no as currently constructed, with some little breadcrumbs that have been left for the right person to find and figure out what tweaks need to be made in order to be judged, for example, that there is genuine economic hedging utility in the contract being considered. So I think we are in the era both of a more favorable CFTC, an era of people picking up the breadcrumb trail that some previous CFTC comments have left and made available, and just an emboldened set of existing CFTC licensees who are starting to say, we're going to ask for forgiveness rather than permission, just start launching some of these products, giving notice, and forcing the issue to potentially go to court if needed.
And needless to say, all of the legislated iGaming operators are paying attention to all of this. But one would surmise, or at least I would guess, that the DraftKings and FanDuels, et cetera, of the world, who would salivate at the opportunity of a national platform upon which to offer products in some capacity and allow people to purchase wagers, or whatever you want to call it, contracts rather, in some capacity. I think that my guess is that we would be more likely to see one of those companies much more seriously evaluate this opportunity than some of the previous forms of real money gaming that are within the gray area.
Yeah, how much of a disruptor could this become if CFTC gives eventually clear guidelines on what is possible and what is not possible? Let's say, we're talking about, again, Crypto.com instantly accessing 50 states, the entire country, right? The marketing bodies that can follow with essentially TAM being the entire US population. It seems to be an incredibly huge opportunity and a massive disruptor to the legacy regulated operators today. Do you think it could be to the extent that we'll see, DraftKings, FanDuel having to abdicate their top spots even as the most popular places to bet?
I think it's tough to say. First of all, it's hard to see an immediate path to offering the more instant gratification, higher margin bets, and same game parlays and micro betting make up a disproportionate amount of revenue for most operators. And so I'm not sure if that's going anywhere. Second, I can't say for sure, but most crypto savvy users of crypto.com, for example, they already can bet on whatever they want within the United States and are most likely, if they're using crypto to do so, are not really being limited by region. Now, Robinhood, certainly that's different, you could imagine, and the ability to potentially participate at 18 years old rather than 21. So I think the answer is not insignificant at all in terms of a disruptor and a major shakeup. I think something that might have a major reaction initially. I don't know how overblown it will or will not be. I do think that to be a permanent disruptor, you need to find a way to get toward that more instant gratification, higher margin, recreational style play. Many of the current conceptions are a little bit more institutional investment style leaning, which is important and valid, and particularly in states that don't offer sports betting, quite valuable, but still not the same as the most popular products today.
And to be clear, I agree with what Lloyd just said. And to be clear, I don't view the emergence of these products as a threat to the existing TAM that DraftKings and FanDuel and others are pursuing, right? It's a different product. Certainly for the next, one would imagine, 12 to 24 months, it's going to be somewhat limited. And those that use the comprehensive product offering with the same game parlays and micro markets and then et cetera, are going to continue to use those products. So I don't think it really represents a threat to the existing market and the existing TAM that these sports books enjoy. But I think that if those sports books were able to pursue a national strategy as a complement to their existing legislated sportsbook strategy, that certainly enhances the TAM opportunity and would be of interest in some capacity.
Brilliant, guys. Let's shift topic here. I want to talk about TopGolf, and I'm sure, like you, I've been visiting the TopGolf venues over in the US and entertained myself by shooting balls out of bounds more than inbounds in recent times. But in any case, the age of the nightclub seems to be a distant past. Or maybe I'm just getting old, I don't know. But seemingly people are looking for alternative ways to socialize and entertain themselves in the 2020s. TopGolf is perhaps the leading franchise on that front that have managed to bring a whole new level of entertainment and socialization by gamifying the driving range experience in recent years and decades even, creating a perfect environment for people to come together in a fun and entertaining way. Now, the success of TopGolf is now leading entrepreneurs to think of other such entertainment venue ideas like mini golf, darts, and of course the OG of entertainment venues, which is bowling. Lloyd, you recently wrote an article where you broke down the TopGolf of X, let's say, what will be the next big TopGolf, the ecosystem as it stands today, and what makes a successful concept. Can you talk about the insights that came from that article and how this trend perhaps is also related to real money gaming?
Yeah, it's a fascinating trend to observe. It seems to be starting and originating in the UK mostly and then expanding elsewhere. TopGolf, Putt Shack and Swingers, which are both mini golf, Flight Club, which is darts, all had their first locations in London and now have many, many locations and hundreds of millions of dollars of funding worldwide. In general, it seems like people are eager to kind of get back out into real life, put their phones down, turn notifications off, connect with like-minded individuals, have something to socialize around that is not heavy alcohol consumption. Doesn't mean you don't have a few beers and enjoy yourself. It just means there's a different centerpiece for the entertainment. And that is sometimes fitness and health and wellness, and sometimes other forms of competition and sport and gaming. And I think that has largely led to the rise of TopGolf for X concepts. Some people call it eatertainment. Over in the UK, they mostly call it competitive socialization. A CSV is a competitive socialization venue. That's what a TopGolf or a Flight Club or a Putt Shack would be. And there's enough of them that they have an acronym for it. And I think you'll see a lot more popularity here. Swingers, the mini golf place, they just announced a $50 million, 40,000 square foot, 3-story facility in Las Vegas. many TopGolfs in Las Vegas already. There's a flight club at the Venetian, and so on. Two parts to your question. Sort of what have we seen from evaluating all these concepts, and then where does real money gaming come in? We have seen, in terms of where real money gaming comes in, I guess, first and foremost. First of all, there's an overlap in the audience. People that seem to enjoy this type of competitive entertainment seem to be easily cross-sold to and from the other types of things that Las Vegas casinos sell. And that's why you're seeing a lot of units go up in and around Las Vegas casinos. But I think the more interesting answer is that there are a few companies out there supplying software to the TopGolfs and Putt Shacks and Boleros and my God, there's TopGolf for cricket and clay pigeon shooting and rowing and I mean every sport you can imagine at this point. And so there's some companies that are supplying software to these folks that do one of two related things. One is allows you to bet real money against other patrons of the same venue. You and I can play darts together, and the venue is not necessarily offering gambling, but through a third-party app, maybe you and I both deposit $10, and then it connects to the scoring mechanism and automatically transfers the money to the winner. Or, somewhat more complicatingly, but in my view, I think more compelling, allow you to bet against the house. Will Pierre hit a bullseye on this shot? Will Pierre score over 60 points on these 3 or 4 shots combined? Yes or no? And you can place that bet yourself, on yourself, against the house, without a companion, and the odds, in theory, will iteratively adapt to your skill set. And I think we're still in the early days for many of these things, but I'll tell you, once you have, whether you like bowling alleys or golf simulators or whatever it is, if you like golf simulators or driving ranges and you go to one that allows you to bet on every swing, will you be within 10 yards of the pin? Will you hit it over 100 yards? And you're the type of person that enjoys a sweat, as presumably most who listen to this podcast probably do. I can assure you, you're not going to want to go back to a regular non-tech enabled, real money gaming driving range anytime soon. And so I think you're going to see a lot of growth in some of those companies that have partnered with many of these driving range bowling alley companies come to fruition, and probably some more on the way. Just briefly, I realize becoming a bit of a long answer. As mentioned, there are so many of these concepts out there. TopGolf for baseball, basketball, football, soccer, clay pigeon shooting, rowing, skiing, snowboarding, you name it, it's out there. They are all fun. You should go to every single one of them. You will be happy with the amount of money that you spend there and the value you get in return. They really are all a blast. Not all of them are investable. And most of them are not investable for venture capital investors seeking, 10x plus returns. What we have found from looking at most of these concepts is that the ones that do generate outsized returns have at least 3, if not all 4, of the following characteristics. 1, they are activities that are conducive to high food and beverage spending. F1 Arcade, for example, which is racing simulators, or T-Squared Social, which is Justin Timberlake and Tiger Woods' place in New York City, they sell $180 seafood towers with caviar supplements and $30 craft cocktails. Other concepts for other sports sell chicken fingers and French fries. Chicken fingers are delicious, not the same margin profile as a seafood tower and a craft cocktail. So you want to be the kind of activity that can sell high-ticket food and beverage. Number 2, you want to look for things that people do more frequently and less on maybe a more novelty-driven or ad hoc basis. I think of axe throwing as the classic novelty-driven activity. The novelty of throwing an axe is what gets people in the door sometimes, but most people don't go axe throwing more than once, whereas people do mini golf and bowling with regularity. So you want to be more like mini golf and bowling. Third, you want to be conducive to corporate events, things that make you sweat, things that will ruin your dress shoes, things that you can't do in high heels, for the most part, are not going to earn you strong corporate event spending. And then fourth and finally, you want to look for opportunities that have high margin tech licensing opportunities. TopGolf's most profitable business line is called Top Tracer. That is a 75% EBITDA margin business where any existing driving range can pay $200 per tee box per month to retrofit TopGolf functionality onto an existing driving range. And so you want to look for opportunities like TopGolf where other facilities can pay you for a white label version. And there's some concepts in the space that lend themselves much better to that and others. So I think you're going to see a lot more of these types of concepts pop up in and around both sports stadiums and hotels and casinos. But as specifically relates to real money gaming, I think the interesting frontier is some of the software companies that are working to allow people to either bet against each other or against the house at these tech-enabled, sports adjacent restaurant, food and beverage, and leisure concepts.
Pierre, I think we can move on to the next topic. I think Lloyd just summarized A to Z and that was definitely a masterclass. I'll add a couple of points, I guess, or reiterate a couple of points from my perspective. One, which is that, look, consumer habits evolve over time, right? And, what we might have referred to the TopGolfer X as a trend, I think is evolving from a trend to just a reality of what going forward is part of what the next generation of consumers is going to be consuming as part of their entertainment. And I don't think it's a trend or a fad. I think it's here to stay. To Lloyd's point, and I know Lloyd's been digging in on this in a lot more detail than I have, but there's a lot more of it coming. There's quite a bit of it on the market today. Some of it will be very successful as businesses. Some will come and go. The big, the ones that will make it. And then within all that, as Lloyd alluded to, maybe even more specific to those of us in the gaming space, is some of these companies that are providing the technology. And you had mentioned, Lloyd, that we always say it's early days, but this really is early days for those companies that are providing the technology that enables folks that visit these types of entertainment centers to participate against one another with a financial outcome, or in some instances, to participate against the house with a financial outcome. And all this has got to work itself out. It's got to work itself out as it pertains to what can you and can't you do from a legislative standpoint, and what are you and aren't you comfortable with, and both as it pertains to against the house as well as two people playing against one another, and people gaining comfort, because we all know that when people go to a golf course, they're often betting on a per hole basis. That isn't anything new, and there's no shortage of golf apps specifically designed to address that. But within the competitive entertainment space and all of these new venues that are popping up, and the idea that there's technology that can enable folks to participate against one another, that I don't want to call that an untapped market, but it's a market that some people have played around with and not found the right sweet spot for. And I think now we're in a place where maybe folks can find that sweet spot.
Yeah, and I'll also just add, I think there's two interesting ways that people will make money in this sub part of the space that Benjie is referring to. One is just on the VIG, on the house edge. You allow people to bet either against themselves and you take a rake, or against the house and you take a VIG. But I think also interestingly, what we see in traditional sports is when people bet, they watch more games, they watch more minutes, they buy more jerseys, they buy more tickets. Similarly, at a food and beverage venue, people who are betting on themselves playing golf simulator or bowling or darts, they stay more minutes, they buy more beers, they buy more French fries, they stay longer, they invite more friends. And so I think people are really starting to see that the unit economics and the consumer behaviors that real money gaming engender are also quite interesting outside of just the casino and the sports book, but many other places that I think will become bigger and bigger parts of the Las Vegas ecosystem, and continuing to see some interesting software companies, to Benjie's point, that are offering this type of functionality and taking everything, whether it's skill-based matchmaking or PAM on the back end, and making that into a turnkey solution for the folks who are operating these venues.
I just love the new $50 million product in Vegas called Swingers, the mini golf product there. I would go just for the name. I don't know about you guys, but I'll see you there next time at G2E. The third topic and the final one here today, I want to zoom in a little bit more on you guys in Benjie and Lloyd. You have now been active for roughly 5 years as investors. Benjie as an angel and Lloyd as a VC, recently launching his second fund, of course. Benjie, talk a little bit about the takeaways, the learnings, the changes over time. What does this all mean to founders moving forward, perhaps in the next 5 years?
Yeah, I mean it's a mammoth of a topic that is kind of hard to discern into one brief
Big
statement
question.
here. And in fairness, Lloyd, you and I on a just in passing when we're having lunch or whatever, we often talk about this as to how much we feel more comfortable now with the decisions we're making. And looking back at some of the decisions we made 5 years ago, we're like, there's no way I would make that same decision today, knowing what I know. And so, look, when we speak within the iGaming space, and we always talk about the founder and wanting to back the right founder, and when I look at my successes, it's not a huge coincidence that the majority of the companies that are either trending towards a fantastic exit, or I'm fortunate enough to say that I've seen some already had some fantastic exits. Generally speaking, the founder is the driver of that, and it's the things that Lloyd and I have been preaching in that regard for me are ringing true. When you have that A+ founder, the likelihood of achieving a significantly successful outcome is exponentially higher, regardless of all the other factors and criteria. But then looking past that, there's things that we know now, right? And I think that we know that when we're looking at businesses that are in some capacity B2B providers within the real money gaming ecosystem, in particularly within the North American market, you need to look at what the TAM opportunity really is. And when you're investing or advising or getting involved with some of these companies, I think we have enough data points now to really be able to zero in with those founders and educate them as to what the reality of their opportunity is. And that doesn't mean it's not a great opportunity, right? And there's always going to be outliers that can move past the thresholds and forge new territory and create oversized outcomes based on that. But I think that it's important that we take into account the learnings of what the exits were. And of course, we had the crazy span in 2020 and 21 when the market was overhyped. And now really we have a few years of being back into what I would phrase as reality. And I think that within that, it's kind of really helped us zero in on what the true unit economics and metrics look like. So, for me, I think that's one of the key learnings is that, really understanding what the opportunity is for that individual founder, and being able to help as an investor guide that within the process for that founder.
Yeah, I think that really have nothing to change and not even too much to add. I think we are making fewer investments that are much larger, raising the bar or having raised the bar for the level of conviction needed to make an investment, and just every single day becoming more and more convinced that the only thing that matters to some extent is the founder, that it has to be a founder whose future earnings you want to own a stake in, regardless of what they're pitching you on. A B+ founder will not, on average, succeed just because they have an A+ product, timing, cap table, opportunity, I think whatever it is. I think it has become a lot easier to be more skeptical about the speed and multiples at which companies like to advertise the ability to potentially exit. And I think perhaps through the painful process of in some cases investing, at the peak of the cycle in 2021, have all learned the importance of extra layers of diligence, of really stress and pressure testing. I think in 2021 and 2020, which not only were the peak of the market, but for this industry coincided with its explosion into mainstream awareness in the US, there were far too many investments made under the assumption of this is just going to be a quick 18-month flip for a 2 to 3x return. Yeah, this won't be a huge outcome, but we know Sport Radar will buy this for 2 to 3x in 18 months from now, as long as we build it. And I think a lot of those kind of things are sort of disappearing from the market. Relatedly, I think looking at an investment and knowing that you shouldn't just rely on there being some other investor who is going to fund the next round if they don't achieve the milestones that they're setting out. And I think that means for some non-industry experts, folks falling away from being willing to supply capital to the market. That's great for us. It gives us more negotiating leverage, certainly in the rounds we're doing, but it makes it scarier and more important that the company isn't, desperate for outside capital come the next round. And what I've noticed is that even, and speak for Benjie here, he's welcome to correct me to any extent necessary, but I've noticed that folks like Benjie, who, in my view, add more value per unit of dilution to the cap tables they join than almost anyone else on those cap tables, they are a lot less interested in just writing a passive check into even a decently priced company with solid founders. Because if you are a Benjie, especially in today's market, you can find a founder who needs some things that from you are very easy to supply, but would add a lot of value on their end, and who wants to maybe raise money only from you at a relatively low valuation and give you a bunch of advisory shares and equity to be, effectively a part-time employee of the company or a contractor, and really work hard on it in your area of expertise and hopefully find your way to an exit without going out and raising a ton of outside capital. And again, not to speak for Benjie, but I think some of his personal greatest successes and ROIs have not necessarily been the deals that have the flashiest headlines, but are the ones where he was uniquely positioned to help really early on, got a crazy blended cost basis that is incredibly low because he was offered a favorable terms and someone saw value in bringing him onto the advisory board. I think, there's a handful of guys like Benjie who seem to have those opportunities these days. No longer are they throwing 50 and 100K checks into deals and taking a passive role. They're really being a lot more selective and focusing opportunities where they can be disproportionately value additive and, receive some meaningful, usually equity remuneration for that is quite substantial in the case of an exit. So I think, for us, again, the main answer is you got to be more focused on the founder because there are much fewer people looking to write a check into the convertible note bridge round that you're going to need to raise if you don't hit all of your milestones. And no amount of market research, I think, can give you enough conviction that those milestones will be hit. You need the conviction that this team will take the right feedback and figure out the way to navigate the company. So that continues to be the number one takeaway. More conviction, more founder focused, writing fewer checks, but larger ones when we find someone who we feel is backable.
And I would add a couple of things on top of that, Lloyd, is that, we've talked in the past about founders that have a bootstrapped mentality. Investors want to see every single dollar count. And I think a founder has to really be able to show the investors whatever capital they're raising, it'll be done with that type of mentality of treating that money as if it was their own and the last dollar they had to spend within that business. And look, I have to be honest, I think it's harder to raise capital today in our space in particular than it ever has been. And I don't mean that to be a negative or to scare anyone away in any way. Look, Lloyd, your firm, you guys are writing checks, but you're so selective and look at so many deals and have so much learning over the last 5 years that guide you to what you're looking for, that the majority of the stuff that comes your way, after a cursory glance, again, I don't want to speak on your behalf, is not going to pass the muster test, right? And the fact of the matter is that, we're 5 or 6 years into this, and there's probably, there's some VCs and some firms that came into this that maybe aren't writing checks today, that got scared away based on 1 or 2 bad investments that they've made, or that they got in at the height of the market into a deal and they're not seeing ROI and now they're less focused on it. Or at a high level, they view sports betting in North America as a duopoly and that ship has sailed and they don't want to dedicate their time and effort to that, right? So I think that when you're a founder and you're bringing forward ideas now, you have to be really, really dialed in and really buttoned up in every piece of this thing in order to catch the attention of the people who you want in. And I would reiterate and agree with you, Lloyd. I'm writing a lot less checks today, but bigger checks than I used to, because the ones that I want to get involved in, I have to have the highest level of conviction that I want to have more capital in it.
It reminds me of something we talked about a while ago, but I think is so true in this industry especially today, and Benjie references it. There was a phenomenon that some people referred to as the Postmates effect, and then they now refer to as the reversal of the Postmates effect. It used to be the intuition in venture capital that in order to make an investment that produces a large enough return, you have to invest in a category leader. You can't invest in the third or fourth best whatever concept. But then in 2020, Postmates, which was like the fourth best food delivery service at the time after Uber Eats and DoorDash and another one, got acquired for $2.6 billion. And so suddenly people said, it's the Postmates effect. Everyone is going to invest in the number 2 or 3 or 4 company in a given category because Postmates has shown that you can do that. I don't know what Postmates market cap is now, but it is much, much lower. And it has turned out in retrospect to just have been a 0% interest rate phenomenon. And so the reversal of the Postmates effect is people saying, actually, wait, that was a mistake. You really do need to invest in the category leader. You need to be the number 1. You can't be in the copycat or the number 2, the number 3, the number 4. And I think especially in this industry, that has hit, some pre-seed seed founders quite hard. I think for us, certainly, I'd say, in the wake of the Odds Jam acquisition, for example, I must have gotten 11 pitch decks of people telling me they're going to be the next Odds Jam. And that is, Odds Jam arguably was already the next Action Network to some extent. I don't know if it is so compelling to a venture capital investor, especially in a space that might sometimes be perceived as being already smaller than other larger spaces like, ed tech or AI or whatever it is. And so I think for us, we really want, are looking for something new and novel and unique that doesn't have a buzzword, that doesn't have a bunch of blog posts already written with a keyword that, easily describes the category, because it seems just based on the data, it's going to be tough to generate a VC wants a 10 or 20 or 50x return, or at least the potential for it if things go well. Once you're the third or fourth or fifth company in a category, and there's already a ceiling on the acquisitions that those companies have taken, again, it doesn't mean you can't run a very successful bootstrap business and make life-changing money for yourself doing that just because 1 or 2 other companies had success. But I do think it means that, especially in the absence of major traction, it's going to be hard to get, a industry-specific or generalist venture capital fund to take that kind of bet. You want to, if you're looking for venture money, I think you want to err on the side of being something that maybe will fail spectacularly, but that if successful is going to create a new category or be something truly disruptive. Otherwise, there's probably other sources of funding, and in particular, trying to find a way to bootstrap that are likely much more prudent.
Yeah, I think the summary here from a founder's perspective is if you are about to go out to raise capital, it's not enough to be just good or even great. You have to imagine yourself in a room of 100 hungry entrepreneurs, and you have to come out as the number 1. There cannot be any other strategy when you pursue seeking investment towards investors, because I would imagine, Lloyd and Benjie, that for every 100 pitch decks that you see, that you take probably 1 investment out of those 100, something like that, right? So rather than taking a shotgun approach and just sending a pitch deck out to all investors you can think of and hope that that someone will bite, it becomes much more about thinking, how can I stand out in this incredibly competitive market of hungry entrepreneurs, and what will make me number 1? Like, start from that basic question as a founder. What will make me stand out in that sea?
I would adjust the question a little bit. I think that you want to build your value proposition and what you and your opportunity bring to the table to make it so darn attractive that there's no reason not to want to be involved in it as any type of an investor, angel, VC, et cetera, et cetera. You want it to be so buttoned up and so attractive, whether you're pre-seed, seed, or wherever it is you are in the ecosystem. You want to have dotted the I's and the T's and planned out a few steps ahead and gotten this thing so buttoned up and made it so strong and added such value that you get to choose which investors you're going to partner with. And you get to choose whether Lloyd is the right fit for you or whether Benjie or somebody else is the right fit for you, because they all want to be involved based on how exciting it is and how unbelievable a job you've done in bringing a value proposition forward.
Brilliant, guys. It's been another fantastic episode here of the Vested Interest. We welcome the year of 2025, and I don't know about you guys, but I'm going to head out to Swingers now. I'll hope I see you guys there. Thank you so much for today.
See you
Thanks,
guys soon.
guys.